Welcome back to this week's edition of Future You. We have some really cool stuff to talk about today. It has been blowing up the press in the mortgage world, and people who don't even follow mortgages as deeply as we do have been asking questions, texting, what is there all about the news on the 50-year mortgage? So, Andy, tell me, good, ugly, bad, what do you think?
That's a loaded question, Andrea. And here's the crazy thing. I think Bill Pulte from FHFA, or maybe even Trump himself, tweeted about bringing out a 50-year mortgage. Everybody's got an opinion on it. The opinions are growing. Some people love the idea. Some people hate it. I figured we'd work on facts and we break it down if that's cool with you.
Yeah, that's amazing. You don't hear a whole lot of facts these days.
Why don't we I've prepared a little bit of visuals for this just to take everybody through it. In fact, I'm going to make the visual the main screen here. All right, so Andrea, let's just look at this real quick. I'm going to take us through a few things about why we're talking about 50-year mortgages, a little bit of a history lesson, and then we'll do some comparisons and anticipations. So Andrea, first, from your perspective, why do you think we're talking about 50-year fixed rate mortgages right now?
I think people are looking for ways to get the lowest mortgage payment possible. And the longer you stretch out a mortgage, it should allow me to do that.
Yeah, I mean, that's basically what's happening. People are looking for lower payment options right now. That's because interest rates on mortgages have risen from 3%, which was an awesome time, 2021, 3% interest rates. Maybe not an awesome time when it came to the pandemic, but the cost of borrowing money was at its lowest, certainly in my lifetime, and much longer than that. It rose to 7 to 8%. So interest rates on homes more than doubled just in the last few years. And at the same time, home prices have been hitting all-time highs, increasing at a faster rate than they did for the 5 decades prior. I think the average home has been appreciating 5 to 7% a year more recently, as opposed to more of 2 to 3% appreciation of prices. Mm-hmm. In some markets, appreciating even faster than that. It's all because inventory's low. There's a lot of people locked in on low interest rates. There hasn't been a lot of inventory out there on home prices, causing them to stay high, even though there's less buyers out there. 3 to 4 times faster rates than median household incomes. I mean, home prices are growing 4 times faster than incomes growing at the moment. So all of this leads to the average first-time home buyer in 2025 is almost 40 years of age. It's one of the highest age ranges that we've seen of first-time home buyers really since we've been recording this data. So homes are, yes, they're less affordable today than they've been. Make sense?
Yeah, totally.
So I think the administration knows that, and they're trying to come up with solutions. And Bill Pulte, the head of FHFA, has really been pushing President Donald Trump to consider a 50-year fixed-rate mortgage as a way to make homes more affordable. But let's go through a history lesson. Andrea, let me just ask you, how long do you think the 30-year fixed-rate mortgage has been around?
Wow. Let's say like the 70s, maybe 60s.
You're actually really, really close. So let's go way back. Pre-1930s, U.S. mortgages were short-term interest-only loans. They usually were anywhere from 3 to 10 years. They were balloon mortgages. I think I have balloon spelled wrong on here, but balloon meant you just paid the interest every month. And then when your term came up, whether it's 3, 4, or 5 years, the entire balance was due. And there was really high down payment requirements on these mortgages. Sometimes they were expecting 40 to 50% to be put down on the house. Now, of course, homes back then only cost a few $1,000s, but think of that in relative terms to income, it was about the same. 1930s come along and FHA is formed. When FHA is formed, they introduce fully amortized long-term fixed-rate mortgages. But when they talked long-term back in the 30s, they were talking about 15-year fixed-rate mortgages, maybe 20-year fixed-rate mortgages, but the 15-year fixed-rate mortgage was the most common mortgage after FHA was formed for at least about 20 or 25 years. In fact, those things happening in the 30s caused homeownership rates to go up almost 50% just in the 20 years when those mortgages were built by FHA. Sometime in the mid-20th century, it's hard for me to really find the dates, but the 30-year fixed-rate mortgage was introduced. And when it was introduced, it was considered radical then, right? There's probably a really good historical comparison to those reacting to a 50-year fixed rate mortgage of like, there's no way. Oh my God, could you imagine having to borrow money for that long of time, your entire life? You couldn't, you'll be dead before you pay this mortgage off. I felt the same way about the 30-year fixed rate mortgage before it really became what is today the most standard loan term in the business. It's 88% of all purchase mortgages are 30-year fixed rate mortgages today. So there is some argument, historically speaking, that it takes time for people to grasp, get a hold of, see the benefits, see the values of an opportunity like this. But let's look into it further, okay? So let's talk about interest rates today. You know, if I asked you, Andrea, what do you think the difference between a 30-year and a 15-year fixed rate mortgage interest rate is today? Let's just use a specific example. You know, this is probably the median sales price of a home, somewhere near $400,000. Let's use a really good scenario. Somebody has the money to put 20% down. It's going to be their primary home. It's going to be their single family home. So they have pretty good credit. What do you think the difference in the rates between the 30 and the 15-year fixed rate mortgage are today?
I would say probably like a quarter.
Okay. They're actually a little bit larger than that. I'm going to show APRs, right, for regulation terms, but the interest rate on this scenario, when I pulled it this morning, again, there's a lot of terms to it, property type, credit score, yada, yada. The APR on the 15-year fixed rate mortgage was just above 6% with a monthly payment of $2,679 a month. And a lifetime payment cost. This is if you made the same payment every month and you held the mortgage for the entire term of the loan for 15 years.
Right.
It would cost you in total payments about $482,220. This is the exact same scenario, the exact same client profile. The interest rate's nearly 1% higher taking out a 30-year fixed rate mortgage. Your payment is almost $500 cheaper because it is a term twice as long as the first term. And your lifetime payment costs are going to be significantly higher. But the reality to it is when we talk to clients today, most are looking for this monthly payment because it's a significant difference. Saving $500 a month is pretty significant. Part of that payment difference is not just the amortization term of the loan, 15 to 30 years, it's the difference in interest rate. Yeah. So why do you think the 30-year fixed interest rate's higher than the 15-year, Andrea?
Well, you're locking a rate in for a lot longer, and you've got the comfort of that for a lot longer, and you've got more time to pay it off.
That's right. So you got to look at this from the opposite side of this transaction. Who's lending this money? The person that's lending this money, they base their interest rate, what they expect to make on the money they lend to you, based on the risk of lending it to you, right? So risk, you know, we've basically frozen all other risks on this scenario. It's the same client, same credit score, same down payment, same property type, same purchase price. Those are all frozen here. The only difference in risk is how long it's going to take me to get my money back from you. And the longer it's going to take me to get my money back from you, the more I'm going to want to charge you. That is the most common, normal way interest rates work in terms of their relationships to how long the money's going to be borrowed. Even the U.S. government, if they issue a 1-year treasury note compared to a 30-year treasury bond, they're going to pay you more interest on the 30-year treasury bond than the 1-year treasury note because you're letting them borrow your money for a lot longer, right? It's just risk. It's a risk assessment. So here's a familiar analogy, right? Car loans. This is probably more people have more experience with car loans today than they do mortgage interest rates probably. So the average car loan term has increased nearly double in the last 20 years. I remember when I bought my first car, typically car loans back in the 90s were 3-year terms. You'd get a 3-year car loan. And I remember when I got my first car, they offered me a 4-year term. And I talked to my dad about it, and he's like, "You're crazy. You need to pay it off in 3 years. Who knows if the car's even going to be working in 3 years?"
Right.
Okay. So, but just think about the mindset behind that. Just 30 years ago, it was like, "Oh my God, you're crazy to do a 4-year car loan." The average term today is almost 6 years on a car loan.
I was going to say, I think I just did mine for 6 years.
Right. I think the last car loan I did for 6 years, right? Because it's nice. The payment's a little bit better. But here, look at the correlation of interest rate on car loans when it comes to term. If you look at your shortest term, say a 36-month term, you're going to get, a 3.89% APR on a car loan today. If you need a car loan for 7 years or longer, they can go up to 8 years now. You're going to pay almost double the interest rate on that car loan than you are on the 36-month loan. Right? So that's why I think what's really important is when we say, is a 50-year fixed rate mortgage a good idea? What I haven't seen people really evaluate yet is what's going to be the interest cost, not over the life of the loan, but what's going to be the interest cost on the 50-year fixed rate mortgage. So let's use this same exact scenario. Purchase price of $400,000, 20% down, primary single family homes, exact same borrower with exact same credit scores. You see, we just put this in front of you a few minutes ago. Based on what you saw in car loan rates and what you've seen in the difference in 30-year to 15-year rates, now what would you anticipate the interest rate to be on a 50-year fixed rate mortgage?
I mean, close to a point higher.
Yes. So, we actually dabbled with Fannie Mae almost 20 years ago on the concept of a 40-year fixed rate mortgage, right?
I remember that.
It was a pilot. It didn't last very long. There are 40-year fixed rate mortgages that exist today, but they're called non-QM mortgages. There's all the same risks are not frozen, and just the term is different. There's different risk profiles on those types of mortgages. But when all the other risk profiles were frozen, and it was just the term, we saw 40-year fixed rate mortgage interest rates about 0.5 point to 0.75 point higher than the 30-year. And almost nobody used them. Why? Because let's apply that to a 50-year fixed rate mortgage. Let's just say that the APR on a 50-year fixed rate mortgage is going to be 3/4 higher. It's 20 years longer recoupment of principal. Your payment difference to the 30-year fixed rate mortgage is only about $50 a month, right? I don't know if the 50-year mortgage rate is going to have this price relationship to the 30-year, but it's probably a good guess based on the, it's probably I'm probably giving a little too much benefit to what the rate might be. I might be too optimistic on it.
Right.
A $50 change in a monthly payment that could end up costing you almost $500,000 more if you held the loan out to term. Now that's an extreme comparison because most people are not going to keep most people don't keep 30-year fixed rate mortgages for 30 years. They keep them 7, 8, 9, 10 years. There's probably, a very low chance somebody's going to take out a 50-year mortgage for the full 50 years.
And actually keep it all 50 years. Right.
So I share all this just to say, how do we feel about the 50-year fixed rate mortgage? I think I'm going to talk for myself. I'm skeptical it's the right solution. I don't think it makes enough of an impact on a payment for it really to make homes that much more affordable for people today. I think there's other opportunities to make homes more affordable today, and we'll do that on a different chapter of Future You. But hopefully, this helped people understand and put into more of a perspective of what this opportunity is, so that people don't get too excited, yet don't throw it out the window right away. Who knows? So again, the 30-year fixed rate, 30-year fixed rate mortgage was considered radical 50 years ago. Who knows what the 50 years today?
Right. That's awesome. And, I think that's one of the important things with talking to a mortgage broker that you trust, because one of the things that we will always find out is, what are your goals? And some people's goals are paying off their mortgage as quickly as possible. That person's not getting a 50-year fixed, right?
Yeah.
But for somebody else, their goal might just be to get in a specific neighborhood because that's where they want their kids' school to be. And that's their first and foremost, most important thing. And if this product helps them do it and makes financial sense for them, then who knows?
Yeah, we always take the approach with our clients to educate and allow the client to make a decision. Whenever you're thinking about buying a home, refinancing a home, are homes affordable to you? You should be working with somebody that provides options, different scenarios, different ways to structure something. If you're not working with somebody that provides you options in different structures, you probably should talk to somebody else, because there are a lot of programs out there in the market today. For the record, the 50-year fixed rate mortgage is not available. It is a concept. It's an idea. They may build this. Bill Pulte may build this in Fannie and Freddie, and it might be a program. And if it becomes a program, we'll educate everybody on it. But our purpose as an organization, as professionals, is to make sure we provide as much information as we can to our clients, ask as many questions as we can to understand what's really important to them, and then put options in front of them. And that's what we can do for you.
Andy, as always, appreciate the insight. And I'm going to have my dad and everyone else who's been texting me watch this video this week.
Thanks for the time, Andrea. Have a great week.
You too.